Picture this. You have extra money sitting in your bank account, but every month that money loses value while you watch from the sidelines. If I were starting my investing journey fresh in 2026, knowing everything I know now, here's exactly what I'd do differently. Most people think investing is complicated, but I'm going to break down the 5-step blueprint that could transform your financial future. We'll cover why your money is actually shrinking if you're not investing, what beginners should buy first, when to start, and I'll show you a 5-step plan that helps you start investing right now. Before we start, if you want to start trading real stocks as little as $10, eToro is the easiest platform I found to get you started. Plus, you can literally copy the moves of top investors if you're new. I'll drop the link down below so you can check it out and grab the free demo account. Let's start with the harsh reality about your money. Right now, while you're keeping cash in savings accounts, something called inflation is quietly stealing your purchasing power. That $7 burger from last year now costs $10. Your money didn't disappear, but it can't buy as much anymore. This is why wealthy people don't keep large amounts in savings accounts. They understand that money needs to work, not just sit there. When you invest, two powerful forces start working for you instead of against you. First, you become a partial owner of profitable businesses. When you buy Apple stock, you own a tiny piece of Apple's success. Every new iPhone sold, every new store open, every innovation they create increases the value of your ownership stake. Second, and this is where things get exciting, you unlock compound interest. Einstein called it the 8th wonder of the world. Here's why this matters for you specifically. Let's say you invest $1,000 monthly, expecting 8% annual returns. After 7 years, you'll hit your first $100,000. That's a significant milestone, but here's where compound interest becomes magical. Your second $100,000 won't take another 7 years. It'll take only 4 years, because now you're earning returns on a much larger base. Your third $100,000 takes just over 3 years. Each milestone gets faster, because your money is earning money on the money it already earned. Once you reach millionaire status, earning each additional $100,000 takes just over 1 year. This acceleration happens because compound interest builds momentum over time, creating wealth that seems impossible when you're starting out. Now you understand why investing beats saving. But what should you actually buy? Most beginners make a critical mistake here. They look at stocks that performed best recently and assume those trends will continue. This approach fails spectacularly. Nokia dominated the phone market in 2010 with 37% market share. By 2020, they held less than 1%, and their stock fell 70%. Past performance never guarantees future results. Picking individual stocks requires predicting which companies will thrive decades from now. That's incredibly difficult, even for professionals. There's a much smarter approach for beginners. Think of individual stock picking like putting all your eggs in one basket. If that basket drops, everything breaks. Instead, successful investing means spreading your eggs across many baskets. This is where index funds become your secret weapon. Index funds offer the perfect solution for beginners who want wealth building without requiring luck or constant market monitoring. Even Warren Buffett, arguably history's greatest investor, recommends index funds for most people. When you invest in an index fund, you automatically own pieces of hundreds of companies. If one company fails, you still own all the others. Your risk spreads across the entire economy instead of depending on individual companies. And here's the most interesting part that no one tells you. If a company fails and no longer performs, it is replaced with another one, which means index funds always go up in the long run. So it's almost impossible to lose money. The key word here being almost. Let me show you a real example. The QQQ fund tracks the NASDAQ 100, which includes the 100 largest non-financial companies on the NASDAQ exchange. When you buy one share of QQQ, you automatically own pieces of Apple, Microsoft, Nvidia, Amazon, and 96 other companies. Apple represents about 10% of this fund, Nvidia about 8.5%, Microsoft 8%. You get instant diversification across America's most innovative companies with a single purchase. And since it was founded back in 1985, it has grown by 21,513%. If you invested $100 in 1985, now you would have had $21,535. And that's without compound interest. But more about this later. Index funds do charge fees called expense ratios, but quality funds keep these very low. While some funds charge 1% annually, excellent index funds charge only 0.1 to 0.5%. On a $10,000 investment, that's just $10 to $50 per year. a small price for professional management and diversification. Before you start investing, complete this two-question checklist. First, do you have high-interest debt above 7%? If yes, pay that off first. This gives you a guaranteed return equal to your interest rate. Think about it logically. If your credit card charges 25% interest on $10,000, you'll pay $2,500 annually just in interest. Paying off that debt immediately saves you $2,500, equivalent to earning a 25% return in the stock market, which is exceptional performance. Second question, do you have 3 to 6 months of expenses saved for emergencies? Without an emergency fund, unexpected costs might force you to sell investments at a loss to cover urgent expenses. Once you've checked both boxes, you can start investing. How much money do you need? You can literally start with $1. Though your returns will be limited by your investment amount. If you invest $10 and earn 10% returns, you make $1. If you invest $10,000 at the same return rate, you make $1,000. The key rule is only invest money you won't need for several years. If you're saving for a house down payment needed next year, don't invest that money. Short-term market movements are unpredictable, and you might need to sell at a loss when you need the cash. Now let's talk about actually making your first investment. Before that, if you found the video useful so far, hit the like button and make sure to subscribe to learn how to invest your money like a professional. No, to make your first investment, you have two main options: retirement accounts or regular brokerage accounts. Retirement accounts like 401ks and IRAs offer tax advantages, but restrict access until age 59 and a half. Brokerage accounts with companies like Fidelity, Schwab, or Moomoo let you deposit and withdraw money anytime, but don't provide the same tax benefits. Most major brokerages offer similar functionality, so choose based on your preferences. I personally use eToro because it's very beginner-friendly and they offer low fees on transactions. Here's the crucial part most beginners get wrong. They don't hold their investments enough. My recommendation, especially for beginners, is to hold for the long term, meaning at least 3 years, preferably much longer. I actually suggest not looking at your investments after buying them. This prevents emotional decision-making that destroys wealth. The biggest mistake new investors make is panic selling when prices drop. Let me show you why emotional investing fails using real market data. Imagine buying the SPY fund, which tracks the S&P 500 in October 2007 for $154 per share. You're investing for the long term, expecting steady growth. Then, the 2008 financial crisis hits. Your investment drops from $154 to $73. You haven't actually lost money yet, because you still own the same number of shares. You only lose money by selling. If you panic sell at $73, you lock in a massive loss. But if you hold through the volatility, something amazing happens. By 2013, SPY recovers to $150. You're back to even. By 2015, it hits $229. You're profitable. In 2018, SPY reaches $291. You've nearly doubled your money. Keep holding through more short-term volatility, and today, SPY trades around $600. That's a 4 times return for patient investors who ignored short-term noise. The lesson is clear. Short-term market movements don't matter if you're investing for the long term. Research shows that missing just the 10 best market days over 10 years reduces your returns by 66%. This happens because markets move up quickly and unpredictably. Trying to time the market, when to buy and sell, usually results in selling low and buying high, which is what most retail traders, also called dumb money, do. It is proven that 90% of day traders lose money, and only 1% consistently profit. Now let's discuss specific index funds worth researching. First is SPLG, the SPDR Portfolio S&P 500 ETF. This fund tracks the S&P 500's 500 largest U.S. companies, representing about 80% of the entire stock market. Its 0.03% expense ratio makes it extremely affordable. This fund offers balanced exposure to well-established businesses, making it ideal for investors wanting stability with growth potential. You get instant diversification across America's largest, most profitable companies. Second is VUG, the Vanguard Growth ETF. This fund focuses on high-growth companies expected to grow faster than average due to innovative technologies or business models. While offering higher growth potential, these companies are are more volatile. VUG charges a 0.04% expense ratio and suits younger investors with higher risk tolerance and longer time horizons. These investors can weather short-term volatility while capturing higher long-term returns. Third is SCHD, the Schwab U.S. Dividend Equity ETF. This fund focuses on large companies that pay regular dividends, cash payments to shareholders. With a 0.06% expense ratio, it's ideal for older investors wanting lower risk and regular income. Dividend-paying companies tend to be more stable, mature businesses that generate consistent cash flow. They're perfect for investors prioritizing steady income over maximum growth. Here's what I'd do differently if starting in 2026. First, I'd immediately check off the two prerequisites: eliminate high-interest debt and build my emergency fund. These steps create the foundation for successful investing. Second, I'd open a brokerage account and start with index funds rather than individual stocks. The diversification and lower risk make index funds perfect for beginners building wealth steadily over time. Third, I'd automate my investments by implementing a dollar-cost average strategy. This removes emotion from the equation and ensures consistent investing regardless of market conditions. A more advanced strategy would be the SDCA, Strategic Dollar Cost Averaging. This is much superior to the DCA, and I will show you exactly how to do it in my next videos. So make sure you subscribe if you want to learn about it. Fourth, I'd completely ignore short-term market movements. I wouldn't check my account daily or react to news headlines about market crashes or booms. Fifth, I'd gradually increase my investment amounts as my income grows. Starting small is fine, but wealth building accelerates as you invest larger amounts over time. The most important lesson is this: time in the market beats timing the market. The earlier you start, the more compound interest works in your favor. Every month you delay investing is a month you lose to build wealth. So let's get you set up with eToro by clicking the link in the description and signing up. And then watching this next video where I show you the only 3 rules you need to successfully invest as a beginner.